The Nasdaq suffered its worst single-day drop since back in the month of October, and the Dow dropped more than 500 points as tech stocks took a massive plunge. And when the market drops, that means it is time to buy. And in this video, we're going to discuss 5 high growth stocks that have seen a big drop over the past week and may be trading at a very attractive level. And when we see big red days in the market, that means some of the best companies in the world are going on sale. And for all 5 stocks in this video, we're going to take a look at their current financial position and the company's future expected growth. But before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. And over the latest trading session, my personal dividend portfolio dropped by 2% or $1,700 in market value. And we can see some of my largest holdings dropped by more than 3 and 4% in one single trading day. But this does not worry me, and I actually like seeing the red in the market because it means I can buy these strong blue chip companies at a better price. And in this video, we're going to focus on 5 high growth tech companies who have seen a massive decline of over 10 to 15% over the past few trading days and may be at a very attractive level. And if we jump into the first company, we have ticker TDOC, which is Teladoc Health. They currently trade for $219 per share, and over the past trading day, the company dropped close to 14% overall. And if we take a closer look, over the past 5 days, the stock is down more than 23%. So definitely a massive decline over the past week in Teladoc shares. And if we take a look, with the pandemic, this is a company that saw an extreme benefit, and the company's share price is up 122%, which includes the over 20% drop in the last few trading days. And right now, the company's current market cap is at just under $37 billion. And right now, Teladoc Health is a leader in a very fast-growing industry in the virtual health space. And going forward, even after the pandemic, the demand and the popularity of virtual care is only going to grow as time goes on. And in 2020, there was more than 10.6 million visits delivered by Teladoc Health clinicians. And more than 40% of Fortune 500 companies are currently using Teladoc Health, which is absolutely amazing. And if we take a look at their financials, they have been expanding at a very fast rate. And over the previous 5 years, their top line revenue CAGR is above 70%, and their average members is growing at more than 40% per year to over 50 million. And Teladoc has also done a very nice job of continuously growing their operating cash flow each and every year as well. And if we take a look at some future growth projections, for the full 2021 fiscal year, we're expecting the total revenue to grow by more than 78%. And for 2022, we're forecasting more than 30% annual growth once again. So going forward, analysts still have a ton of future expectations, and Teladoc Health has a bright future ahead. So they are definitely a growth company to take a look at after the 23% decline that we've witnessed over the past week. And now if we move on to company number 2, we're going to take a look at PayPal, ticker PYPL, that currently trades for $254 per share. And if we take a look at the share price chart, 5 days ago, the company was trading above 292, and now they have seen an over 13% decline to their current share price, dropping more than $38 per share. And the company over the trailing 12 months is still up 128%. And their current market cap is at $311 billion, making them the leader in the fintech space. And going forward, the entire financial tech sector is expected to grow at a high double-digit rate over the next decade in the future. And I personally like to invest in companies that I use myself. And I use PayPal services every single week. They're convenient, they're safe, and I trust the brand, and I think that's what's going to allow them to have long-term success. If I trust the PayPal name, I'm sure millions of consumers all across the country feel the same way. And going forward, the company's predicting some massive growth over the next 5 years in the future. They're predicting to double their active accounts and reach over 750 million people, which is a 15% CAGR from where they are today. And they're expecting over $50 billion in revenue in 2025, a 20% CAGR from their current level of over 21 billion. And I think if they can achieve these numbers, the share price for this company will be much higher than where it is today. And going forward, they're also expecting to grow their bottom line or their earnings per share by 22% year over year as well. And Wall Street is predicting a ton of future growth from PayPal. Over the next 5 years, analysts are expecting more than 22% per year growth, and the company is currently rated as a strong buy, coming in at a 1.8. And the current share price of $253 sits well below the 12-month expectation of $311, representing a ton of short and long-term upside in PayPal share price. And this is a company that is trusted by hundreds of millions of Americans, and they use them every single week. They are a trusted source in the fintech world, and I think over the long term, as we continue to shift towards a digital society, PayPal is always going to grow in demand. They continue to innovate, come out with new products, and going to be a long-term leader in this financial space. So definitely a great company to take a look at on the 13% decline that we've seen over the past few trading days. And now we're going to transition away from PayPal and into the third stock, which is Advanced Micro Devices. Ticker AMD, currently trading for over $82 per share, and the company has grown by 77% over the past year. Their current market cap is just above 105 billion, and they're trading with a forward PE of 45.2. And if we take a look at the 1-month chart, the company is down by 13%. So a nice little decline from one of the top companies in the semiconductor space, which is expected to go through a mass acceleration in 2021. And if we take a look, AMD has some great financial statements. Year over year, total revenue continues to grow, peaking at close to 9.8 billion in the trailing 12 months. And over this past year, the company has also brought in record high net income of close to $2.5 billion. And their balance sheet is also very strong as well. They have over $6 billion of total current assets, and their total current debt only comes in at $2.4 billion. So a nice current ratio well above 2, and overall, this company has very little long-term debt, and the total liabilities are only at $3.1 billion. So the total current assets on hand can cover all of their current debt, and the company will still have close to $3 billion of assets on hand. So I think the company's short-term and long-term financial position is very strong, and year over year, total equity continues to grow at a very fast rate, which is a very strong sign for AMD investors. And taking a look over the long term, they're predicting a 20% CAGR in their overall revenue with gross margins above 50%. And they're also expecting to generate a ton of cash with a free cash flow margin of over 15% over the long term. And if we take a look at Wall Street predictions, we're expecting over 26% per year growth going forward, and the company is currently rated as a buy. And the share price of $82 sits well below the average expectation of $102 per share over the next 12 months. So AMD is on a 13% decline right now, and they are the third company to take a look at this current point in time. And now if we move right on into number 4, we're going to take a look at Amazon, the largest e-commerce platform in the world, the giant that powers our everyday shopping needs, and the company currently trades for over $3,000 per share. And in their trailing 12 months, they are up by 57%. And the company's current market cap is at just below $1.6 trillion. But if we take a look at the 6-month chart for Amazon, we can see that from their high point of over $3,500 per share, the company is actually down more than 13% at this current level. And with Amazon, this is a company that I believe is going to dominate the e-commerce world for decades in the future. I don't see any competitor coming in and kicking Amazon out of their market leadership position. And if we take a look at Amazon's income statement, year over year, they continue to expand at a massive rate. And in 2020, they generated more than $386 billion of total revenue. That's just incredible. In a 1-year span from 2019 to 2020, they increased their total revenue number by $106 billion. $106 billion increase in total revenue in one single year is absolutely insane. So there's no reason, in my personal opinion, that we should see Amazon down so much. And I think this is a company that can be worth over $2 to $3 trillion in the next 3 to 5 years. And if we take a look at their bottom line, they are now somewhat focused on growing net income. And in 2020, they generated more than $21 billion of total profits as well. And again, this is a number that continues to grow at an exponential rate year over year. And for the next 5 years, analysts are predicting over 38% per year growth in Amazon shares. That's just insane. 38% per year growth from already one of the largest companies in the world would be absolutely incredible. The company is considered a strong buy at this current level, and the share price of just over $3,000 sits well below the average expectation of $4,000 per share, indicating more than 30% potential upside. So Amazon was the fourth company to buy the dip on right now. The entire sector has been hit extremely hard, and to get any of the first four names that we've already discussed at an over 10% decline is definitely worth taking a look at. And now if we move on to the final company in this video, we're going to go over Adobe, ticker ADBE, currently trading for $459 per share, and the company is up 33% over the trailing 12 months. And like we've done for all the other stocks, if we actually take a closer look, we can see that in the past 6 months, the company reached a high of over $533. And from that high point, they now sit at around $460, which is a 14% decline to their current share price. And this is one of the largest software companies in the world right now. And they continue to innovate and are growing their product line each and every year. And overall, the Creative Cloud is a subscription-based model that I think is going to drive the company over the long term. With this Creative Cloud system that they continue to grow and come out with new services, it is a full range of products that can allow you to do every type of digital need. And right now, Adobe is the leader in this industry, and their products are way above their next competitor in quality and efficiency. And if we take a look, 2020 was a great year for Adobe. In the full year, top line revenue was up 15%, earnings per share grew 81% overall, and they generated over $5.7 billion of cash flow from operations. And in 2021, they're predicting some nice growth as well in the high double-digit range for all of their business segments. And if we take a look at Wall Street predictions, they still have high expectations for this software company over the next 5 years as well. And they're predicting over 16% per year growth, and the company is currently considered a strong buy, and the current share price of $460 is well below the 12-month expectation of $563 per share. So overall, one of the leading software companies, a very high margin business, very good products, and I think Adobe is going to be around for a long period of time. And they were the fifth company and the fifth big name tech stock to buy the dip over the red we've seen in the market. And one last point that I want to share is that next time you log into your account and you see a ton of red like we have on the map, don't panic, don't freak out, and don't sell out of your investments just because of short-term fluctuations. If nothing has changed with the underlying companies that you own, then there's no need to sell. Don't panic sell, it doesn't work. If you hold strong blue chip companies, whether they're dividend payers or growth names, and you believe that the companies are still going to be larger over the next 3, 5, 10 years, then there's no need to sell the stock because of some short-term fluctuations. The stock market is volatile. It goes up, but it also goes down, and you have to understand that red days are going to come all the time. And just remember that all of our historical data shows that over the long term, the stock market has gone up, and we're expecting that growth to continue for many decades in the future. So I want to thank you for watching, everyone. I am the Gen Z Investor, and in this video, we talked about 5 big tech companies that have seen a big decline as of late and may be worth buying the dip at their current share price. So I want to thank you for watching to the end. Please hit that like button and subscribe, and I will see you in tomorrow's video.